Hi everyone, welcome to the first topic that will be covered under this course called CFE Preparation Financial Reporting Topics. And the first topic will be revenue. This topic is going to be the most important topic when you're studying for the CFE, and the reason is because it is the most commonly tested financial reporting topic. And historically it's been tested between 1 to 3 times on each CFE or UFE, sometimes even 4. So definitely make this your priority when studying for financial reporting. Some of the subtopics that we'll be covering today include the revenue recognition criteria for both sale of goods and rendering of services. These come up quite frequently on the CFE and historically UFE. In addition, make sure you understand the separately identifiable components, gross versus net reporting, and bill and hold transactions standards. In addition, I'll provide some advice on how to navigate the PDF viewer in Secure Exam in order to find the standards efficiently. So let's move on to the sale of goods. So make sure you understand these revenue recognition criteria and where they are in the PDF viewer because it's so key when writing the CFE. So for IFRS, there are 5 criteria for the sale of goods. And so the following are: first, the entity must have transferred its significant risks and rewards of ownership of the goods to another entity, that the entity no longer has continuing managerial involvement or effective control over the goods, and that the entity can measure reliably its revenues and costs, and that future economic benefits associated with the goods are probable. So those are the 5 for IFRS. ASPE considers first that performance has been achieved and that collection is reasonably assured. And so for performance to have been achieved, there must be 3 things to happen. There's persuasive evidence of an arrangement, delivery of the goods or services have occurred, and that the price is fixed or determinable. And so all 3 of these criteria for performance have additional guidance under ASPE 3400 from paragraphs 8 to 10. And so keep in mind that this bullet, the performance achieved in collection reasonably assured, also applies to the rendering of services. So that's the difference between ASPE and IFRS. In addition, under ASPE, the significant risks and rewards should have been transferred as well. So that's the same as under IFRS. In addition, the significant acts should have been completed in order for there to be significant risks and rewards, and that there's no continuing managerial involvement or effective control. So again, these, the no continuing managerial involvement, you can see was also under IFRS. The difference is that it does talk about significant acts explicitly. And lastly, that reasonable assurance over measurement of revenues is also a requirement. So Michael Moores has an arrangement to sell his handbag inventory on consignment to the Hudson's Hay for $1,000 per handbag. Moores has delivered 50 bags to the Hay, and the Hudson's Hay currently holds 40 units of Moores bags and has sold 10 units to end consumers. Assuming Moores is a public company, what amount of sales can Michael Moores book as revenue? $0, $10,000, $40,000, or $50,000. So before we move on to the solution, we know that this is consignment inventory sale because it explicitly says sold its inventory on consignment to the Hudson's Hay. So that's definitely something that you should underline when you're doing cases like this on the CFE. In addition, once we know that it's on consignment, we need to know how many have actually been sold to the end consumers. And here we see that 10 units have been sold to the end consumers, therefore leaving 40 units remaining. Now let's move on to the solution for example 1. So we know that the problem is that there was a consignment sale of inventory, and we know that also the correct standard that we should be applying is IFRS. And we know this because the question specifically stated that Moores is a publicly traded company. Next, we should assess the revenue recognition criteria. So first, let's look at the 10 units sold. And we know that there is significant risks and rewards of ownership transferred because they've been sold to the end consumer, and that Michael Moore's no longer has effective control or continuing managerial involvement. Revenues can be measured reliably because we know each bag is $1,000, and that probable future economic benefits will occur because the end consumer has made the purchase either through cash or debit or credit. Here, costs are reliably measured. This we can assume because the question hasn't provided us with too much information. And so in your CFE response, if this was a CFE question, you would write that it is assumed. So now let's look at the 40 units held. So for the 40 units, we know that Hudson's Hay still holds the bags rather than has sold it to end consumers. So as a result, the sale should not be booked as revenue because the significant risks and rewards of ownership have not been transferred. And so oftentimes, if there's no remaining time on the CFE, if you see that this one criteria hasn't been met, there's no need to address the remaining criteria. However, if this is for a day 2 case, and if this problem is one of the larger, if it has more text, then you should still consider writing the other criteria, but quickly mention whether it's been met or not. So revenue can still be reliably measured just because we know it's $1,000. However, probable future economic benefits, it's hard to say if it's probable because the bags haven't been sold to the consumers. Here, this is again assumed, and for continuing managerial involvement, we could say yes still because we're saying that Hudson's Hay has managerial involvement, but at the same time, it doesn't even matter since as long as one of these 5 have not been met, you cannot record revenue. As a conclusion, we see that the 10 units sold, there's check marks for all of these criteria. Therefore, those 10 units can be recognized as revenue, so that would be $10,000 since it's $1,000 per bag. Moving on to the revenue recognition criteria for services, we see that 3 of the criteria for the rendering of service revenue recognition is the same as the revenue criteria for the sale of goods. So the bottom 3, revenue reliably measured, cost reliably measured, probable economic benefits, those are the same. The one that you should focus on and know that is different is that the stage of completion for services can be measured reliably. So that's unique to rendering of services. Under IFRS, we should be using the percentage of completion method unless the outcome can't be reliably measured, in which case we would use cost recovery method, and all that is that revenue can only be recognized to the extent that costs were incurred. In addition, if there is a significant act in the rendering of services, then you would measure revenue only after the significant act has occurred. Under ASPE, we see that the performance achieved in collection is reasonably assured criteria are the same as the ones from the sale of goods. In addition, we should be using the percentage of completion method here, similar to IFRS, unless the performance is after one single act. So then it would be similar to IFRS where you book the revenues after that act, or if the progress is not measurable, in which case you don't know how much of your services are being provided over the course of the contract, for example, or that consideration is not measurable. So if it's not in cash, the dollar amount hasn't been written in the contract, for example. And then in these cases, we would be using the completed contract method under ASPE rather than IFRS. Under completed contract method, you can recognize revenue once the contract has been substantially complete or fully completed. So let's move on to an example for the rendering of services. Von Grills, a startup company, has engaged Oxford Properties to build the largest shopping mall in Vaughan by June 30th, 2019, 24 months from today. The entire contract is worth $2 million in sales and will cost Oxford $750,000 to build. Services will be provided in the following fashion: 50% of services in the first 6 months, 25% in the next 6 months, 20% in the next 6 thereafter, and 5% in the last 6 months of the contract. Costs will be incurred evenly throughout the 24-month contract. Von Grills has already paid Oxford a $500,000 deposit on January 1st, 2017, and will be paying $1 million on June 30th, 2018, and the remaining $500,000 on June 30th, 2019. Oxford Properties has already booked $500,000 on January 1st, 2017, and wants to verify how much revenue it should book for the 2017 year relating to the construction project under both ASPE and IFRS. I'm going to start marking up some of the points here that are important. So we see that construction project will be built by June 30th, 2019, and today's date must therefore be June 30th, 2017, because it says 24 months from today. So keep that in mind. And that the entire contract was worth $2 million in sales, and that we know what the cost is as well. So let's actually make sure we understand what the question is. So how much revenue it should book for the 2017 year? And we know that it's already booked $500,000 as revenue. We also know that services will be provided in the following stages over here. And we also know costs will be incurred evenly. And that Von Grills has already paid Oxford $500,000. We identified that this is obviously revenue recognition of services rendered relating to a construction project. And we should be assessing the revenue recognition criteria. And going back to IFRS, we know that the stage of completion can be used, and that the revenue and cost can be reliably measured, which we saw that we had numbers to back the revenue and costs. The costs were $750K, revenues were $2 million. Very similar thing for ASPE. We see that performance can be measured reliably, performance can be reasonably assured, and collection can also occur. So we know there isn't too much information in the case, but we can assume that collection is reasonably assured just because Von Grills has already paid $500,000. And using case facts, we also don't have any reason to believe that the outcome can't be reliably measured, or any of those exceptions for not using the percentage of completion method. Based on the case facts, based on the revenue recognition criteria, we can see that the percentage of completion method is appropriate under both IFRS and ASPE, and there's no single act that's significantly larger than the others. I mean, there is 50% of the revenues to be recognized in the first 6 months, but that's not a single act. And so to conclude, the $500,000 of cash that was paid up front to Oxford Properties should not have been recognized, since under accrual accounting, revenues can only be recognized when the services were actually rendered. And services aren't rendered until starting at the earliest July 1st, 2017, since the contract started June 30th, 2017. So we know $500,000 should not have been booked. In addition, we should conclude that because we know percentage of completion method is appropriate, that revenue can be booked in accordance with the stage of completion that's stated in the question. So 50%, 25%, 20%, and then 5% for each 6 months. For the 2017 year, we know that there's only 6 months left in the 2017 year after the contract started in June 30th, 2017. So that means 50% of the $2 million contract, as per the stage of completion, can be booked as revenue. So that equals $1 million in revenue for 2017. Now let's move on to the next topic, which is separately identifiable components. The standards are actually the same under both IFRS and ASPE, and it states that revenue recognition criteria should be applied to separately identifiable components of a single transaction in order to reflect the substance of the transaction. For example, this includes bundled packages, such as having a product, but the cost to the consumer, so the selling price, is higher because it's bundled with a service than if you had bought the product standalone. And in this case, the revenue associated with the service is deferred and recognized over the service period. So for example, FutureFlop is known for providing great 5-year warranty services for laptops. It recently sold 100 laptop units for $850 each, which includes their famous warranty. Without the warranties, the laptops sell for only $620. So in this case, we know the difference between $850, which is the bundled package, versus the standalone is $230. And so in terms of booking revenue right away, if they've already sold the 100 laptop units to consumers, we know that we would consider the laptop and the service separate. So for the laptops, we look at the revenue recognition criteria. So for example, significant risks and rewards. Yes, those have been transferred because the laptop has been sold. So the revenue relating only to the standalone laptop can be recognized as the $620 standalone price times the 100 units. So that would be $62,000. However, the remaining revenue associated with the laptop bundle, so the difference between $850 and $620, so that's the $230. So that amount we would amortize over the 5-year period and recognize $230 times 100 units divided by 5 each year. So that equates to $46,000 per year. Gross versus net reporting is the next topic that we'll be discussing. And it actually comes up relatively often, so it's definitely good to know. Under IFRS, the only information under the entire standard is in paragraph 8. And so it's a small paragraph which just discusses how revenue is essentially the gross economic benefits to the person, to the entity providing that service or sale of goods, and that the agent, not the principal, records the revenue on a net basis, while principals record them on a gross basis. For ASPE, it has that very identical or similar paragraph, but also provides additional criteria which will help determine whether a transaction should be recorded as gross versus net. So points that support reporting revenue on a gross basis, or in other words, that the entity is a principal, is that the entity has primary responsibility for providing the service, that the entity takes on the inventory risk, that it has latitude in establishing the prices of the good or service, and that it takes on the credit risk associated with the customers. The one point that's supporting the net basis, or in other words, an agent, is that the fee is predetermined. In other words, a fixed dollar value or a fixed percentage commission. So let's look at an example for Muma's Bookstore. It's a private company which sells books published by Variety Publishing House on consignment. Muma obtains a 25% commission per book, and the average selling price per book is $20. If Muma sells 10,000 units of Variety's books, how much revenue should Muma book? So we know that it's a private company, therefore it should be using ASPE. And under ASPE, there are a number of criteria. Keep in mind that these criteria can also be applied in an IFRS or public company situation because there are no specific criteria available under IFRS. So moving on to the solution, we look at the different criteria available here. And the first is that there's primary responsibility for providing the good or service. Here we know that the Variety Publishing House is the one that's primarily responsible for providing the book because they're the ones who published it. For inventory risk, similar, it's the principal who takes on this inventory risk because the inventory is on consignment. For the latitude in establishing prices, again, the publishing house is the one that who determines what the selling price of the books are. For the credit risk of the customers, you could debate either way. It doesn't really matter here just because even if you argue that Muma is the one that takes on the credit risk, it's only 1 point under MUMA to be principal. So this is up for debate, considering that there's not that much information in this case. Lastly, if there's a predetermined fee, such as a commission, which is the case here, the 25% commission, that supports the agent view for MUMA. So overall, we can see that the first 3 or maybe 4 are supporting that variety is the principal, and the last one supports the same thing, that MUMA is the agent. So in conclusion, MUMA is the agent and variety is the principal, and MUMA can record the 25% commission associated with the 10,000 units sold, which equates to $50,000 of revenues. Last but not least, in terms of the topics we'll be covering today, that includes bill and hold arrangements. Note that these arrangements are when a sale has been made but the buyer has specifically requested a delay in delivery. However, they're still taking the title or ownership of the good. What's interesting to note is that these bill and hold arrangements are available in paragraph IE1. However, it is not in the PDF viewer. So it's definitely something that you'll have to just memorize as opposed to go into the PDF viewer and copy and paste the criteria if what you want is competent with distinction. Generally, if you can apply the 5 or 4 revenue criteria for sale of goods and rendering of services in a case situation, and use the case facts in detail with a conclusion that's generally sufficient to obtain a competent on the CFE. So the 4 revenue recognition criteria for bill and hold arrangements specifically is that probable delivery will be made, and probable means greater than 50%, that the item is on hand and ready to be delivered, that's important. C, that the buyer acknowledges the deferred delivery instructions, generally written down, for example, a signature on a contract, and that the usual payment terms apply. When navigating the PDF viewer, let's start with IAS 18 revenues. So before you go and look at the different sections of each of these standards, make sure you take a look at the table of contents and notice where all of the different sections are. So for example, the measurement of revenue is under paragraph 9, then followed by identification, sale of goods, rendering of services. And we see that every section starts with the scope, the definitions. And here, this is one of the first pieces of information that you should be aware of. And usually anything that's really important has been bolded. Here in the identification of transaction, it talks about the separately identifiable components of a single transaction. In addition, you should also know the linked transactions. You can read this during your own time. Then we see the 5 criteria that we talked about for the sale of goods. This again has been bolded. And then there's additional information on that here. So make sure you know where everything is. This one is the rendering of services. And we can see here it talks about how the stage of completion can be determined, and that there's a couple examples here, such as surveys of work performed, services performed, proportion of costs to total costs. Yeah, and then they also bolded, when the outcome cannot be estimated reliably, then revenues shall be recognized only to the extent that expenses are recoverable. So this is the cost recovery method that I was talking about earlier. There's some additional information on interest, royalties, and dividends. However, that's pretty rare on a CFE or UFE, but just make sure you know where everything is so you can easily control F. So for example, if you wanted to know where the information regarding principal versus agent, you would type in principal, enter, and then it will show where those words pop up. So it's under paragraph 8, and this is the only guidance relating to gross versus net reporting here. Similarly, for ASPE 3400, which is the revenue standard, you should also understand where everything is in the standard. So again, the scope, the definition, and then followed by recognition and presentation. So generally these two sections, definition and scope, are not as important, but it is helpful if you don't know the definitions of certain things. So these couple paragraphs are pretty important, which are relating to the performance and the criteria of recognition, which we discussed earlier. This is where it talks about the performance criteria. Yeah, so for example, these are the sections where it talks about how do we determine if delivery has occurred, and there's a couple examples, when it hasn't or you need to consider. And then in addition, it talks about whether the price is fixed or determinable, and you would consider these factors here. There's a couple additional areas that it talks about, like significant risks and rewards as well. Unfortunately, the ASPE, it doesn't bold a bunch of paragraphs. Yeah, it talks about uncertainties here. And here is where you can easily just copy all of this and right-click. Copy selected text, and then you can copy and paste that into a Word doc or the secure exam case response. And then just write the case facts after each of these different criteria. And actually this one is as well. That's what I recommend. Yeah, those are pretty much the key sections there. Thanks so much for watching this video, and we'll see you in the next one.